Hello and welcome to FAR 3. So guys, we are on a roll out here. In FAR 2, we started looking at our financial statements. We are looking at a statement of financial position, the balance sheet. We started with looking at the current assets and current liabilities on a balance sheet. So we looked at cash and cash equivalents. We talked about accounts receivable. We've talked about inventory that we have. Now in FAR 3, we'll go on further with the balance sheet. We're going to start with looking at investments. So investments are those that we make in other entities. So we invest in other entities. That is investments. It could be non-current or current. We'll talk about that. Then as we move on with FAR 3, we'll look at PP&E, that's property, plant and equipment, our fixed asset. We'll also look at intangible assets. We'll also talk about goodwill. So guys, a lot of content to come in FAR 3 and trust me, it's going to be real fun and exciting. So let's start with talking about the very important investments. So guys, as you can understand, investments, that's in other entities. When we talk about PP&E, intangibles, that's like investments in ourselves. In FAR 3.1, let's get to page 2. Where we look at investments. We'll start with investment in equity securities and then we look at investment in debt securities. Now the accounting for investment in equity securities depends upon the ownership percentage or the influence or control that the investor has on the investee. So draw a bracket there and write based on ownership percentage. Now, if the investor has no influence on the investee, generally this is ownership percentage less than 20%, then the investor accounts for these investments using highlight FVTNI. So that is fair value through net income. That means the gain or loss on these securities that's recorded on the income statement rolls into the net income. Of course, there is highlight an exception if fair value not readily determinable. And we're going to talk about cost less impairment adjusted for observable price changes. IFRS is pretty similar. They say FVTPL, so that's fair value through profit and loss. Same thing as FVTNI. But IFRS allows underline may elect FVTOCI and right there only IFRS. So this is fair value through other comprehensive income. This is no longer allowed under US GAAP for equity securities, and we're going to talk about this. So guys, we've looked at accounting for investments where the investor has no influence, and generally we're talking about ownership percentage less than 20%. However, if the investor has significant influence, you could talk about ownership percentage ranging from 20% to 50%, then the investor accounts for that investment using highlight equity method. And the investor may elect underline fair value option. And if the investor controls the investee, that means the investor owns over 50% of the investee, in that case, we consolidate. And we're going to talk about consolidation and consolidated financial statements in FAR 6.1. So in this section, FAR 3.1, we look at the investments in equity securities where the investor has no influence, let's say less than 20% ownership, or has significant influence, 20 to 50% ownership of the investee. On page 3, highlight FVTNI. So this is fair value through net income. And this method of accounting for investment in equity securities is used when the investor has no influence and fair value is readily determinable. So when we say fair value, basically the investment in equity securities needs to be measured at fair value on the balance sheet. And any resultant gain or loss, whether realized or unrealized, is recorded in income statement. So guys, note again, fair value through net income. So we're going to have the investment in equity securities at fair value on the balance sheet, and any gain or loss due to the change in fair value is recorded in the income statement through net income. Whether the gain or loss is realized or unrealized, all of it is part of net income on the income statement. Also, even dividend income is included in earnings on the income statement. So once again, we're saying fair value through net income. On page 4, we're looking at the put a box around exception to account for investment in equity securities if the fair value of those securities are not readily determinable. And we use highlight cost, which is adjusted for impairment as well as any observable price changes. So basically the scenario is no influence and fair value not readily determinable, the exception. And as we discussed, in such a scenario, the investment in those equity securities are recorded at highlight cost, circle minus and underline impairment, circle plus or minus and underline observable price changes. So let's look at an example where an investor owns less than 20% of an investee whose equity securities are not publicly traded. So basically a private company investee. Now in that case, the fair value of those equity securities held by the investor is not readily determinable and the exception rule kicks in, where the investor records for those securities at cost. Of course, periodically, the investor determines if those securities are impaired. If yes, they're going to be impairment losses. Also, the investor needs to be on a lookout for any observable price changes of those equity securities. Think about it. Let's say the investee goes for a subsequent round of funding, which leads to a new value for the equity securities. Now, that one is an observable price change, which needs to be factored by the investor in the value of the investment. So once again, we're going to look at investment at cost, the original price which the investor paid for those securities, adjusted for any impairment losses, and also adjusted for any observable price changes. Scroll down towards the bottom of the page and note that even under this exception rule, highlight dividend income is included in earnings. So that's on the income statement. On page 5, we're looking at accounting for investment in equity securities when the investor has significant influence. And in this case, the investor uses the equity method to account for those securities. Now, when we say significant influence, we are talking about highlight generally 20 to 50% stock ownership. However, there could be cases, highlight exception 1, where you need to use equity method when significant influence exists even if ownership is less than 20%. For example, let's say the investor has definite intentions of increasing the stake to 20% or more. Or let's say the investee has significant technological or transactional dependency on the investor. Or let's say the investor has representation on the board of directors of the investee. Or the investor is a major customer or supplier of the investee. Or the investor owns at least 20% of the voting stock of the investee. So all these indicate significant influence, and it could be possible that the investor exercises significant influence even though the investor owns less than 20%. But as I said, generally we are looking at 20 to 50% stock ownership. To the contrary, let's look at highlight exception 2. Do not use equity method if influence does not exist but ownership is 20 to 50%. So as I said, it's the significant influence that matters most. Don't get fixated on the percentage. So let's say the investment in the investee is only temporary, or the investee is going through bankruptcy, or the investor surrenders significant rights as a shareholder under a standstill agreement, or the investor does not even obtain a representation on the board of directors. Or let's say another group of shareholders have majority ownership and exercise total control. So basically what we're saying is that there could be cases where the investor has 20 to 50% stake but does not exercise significant influence. And in such cases, we do not use the equity method. So bottom line, equity method is used when the investor has significant influence. And now let's talk about the accounting treatment under this equity method. Highlight original investment is recorded at cost. Highlight any difference between the purchase price paid for the investee and the book value of the investee's net assets must be accounted for. So once again, we are looking at the difference between, put a box around, purchase price paid for the investee and put a box around book value of the investee's assets net of liabilities. So when we're talking about this difference, we first look at, put a box around, fair value of the investee's net assets. So the difference between the book value and the fair value of investee's net assets is generally due to the difference between the book value and fair value of non-monetary assets of the investee, like highlight land, highlight PP&E or property, plant and equipment, highlight inventory, and the excess over fair value that is paid by the investor to the investee. So the difference between fair value and the purchase price, that is highlight goodwill. A quick exam tip here. When you're looking at the fair value or the book value of the investee's net assets, remember to highlight multiply by the percentage ownership of the investor. So often exam questions would have the fair value of the investee's net assets or the book value of the investee's net assets. And you need to remember that the investor owns only a portion of that, let's say 30% of that. So you need to multiply 30% by that number, which is the fair value of the investee's net assets or the book value of investee net assets. Couple of other pointers on the equity method. So as the investee earns profit, highlight record percentage of investee's earnings as equity in earnings on income statement of the investor. So guys, as and when the investee earns money, the investor recognizes income, irrespective of whether the investor receives the dividend. And when highlight dividends are actually received, they are reduced from investment account and not treated as income on the income statement. So guys, once again, very quickly, recapping this. So equity method, the original investment is recorded at cost. Any difference between the purchase price paid for the investee and the book value of the investee's net assets must be accounted for by the investor. As and when the investee earns profits, the investor recognizes income. But when the investee pays out dividends, which are received by the investor, they are not treated as income by the investor. Instead, they are reduced from the investment account. And to understand all these better, let's look at the example on the next page. On page 6, we have our example on put a box around equity method. On Jan 1st, 2010, big company acquired 30% of small company for $100,000. Now, small company's fair value is $300,000 and book value is $250,000. So the excess $50,000 fair value is attributed to land $20,000, PP&E other than land $20,000 and inventory $10,000. Now, during the year, small company reports income of $25,000 and pays dividends of $6,000. And then we have a note that goodwill is impaired by 25% during the year. PP&E is to be depreciated over 10 years. And inventory with a higher fair value is sold during the year. So let's first look at the purchase price versus fair value versus book value. So highlight purchase price, and we know that's $100,000. Highlight fair value of big's share of small. So the fair value of small company is $300,000 on Jan 1st. 30% of that is $90,000. And then highlight book value. So the book value of big's share of small is 30% of $250,000, which is $75,000. So the difference between fair value and book value is $50,000, and 30% of that is $15,000, which is highlight the excess of fair value over book value. The fair value of big share of small, that's 30% of small, is $90,000. However, big paid $100,000 to acquire that 30%. The $10,000 excess of purchase price over fair value is highlight goodwill. Now let's quickly look at the journal entries under the equity method. So when big acquires 30% of small, the investment is recorded at cost. So write invest and highlight investment, which is debited for $100,000. When small earns $25,000 during the year, big records earnings of 30% of that, which is $7,500. So right there, earn, and that earnings leads to an increase in big's highlight investment by $7,500. The credit of that journal entry is equity in earnings. Basically, this income is recorded on Circle income statement. However, when big receives dividend from small, so small pays out dividends of $6,000. Big owns 30%, so gets a dividend of $1,800. So, right, when big receives dividend, it's cash debit and highlight investment credit. Drop bracket there and write dividend equals no income statement impact. So guys, note the investor is recognizing income when the investee is earning money. When the investee pays out dividends, then the investor does not again recognize an income. That's a reduction of the investment by the investor. And now we need to look at write-off. So when we look at write-offs, we are looking at the difference between the book value of the investee and the purchase price paid by the investor. And in this example, the difference between the book value and the purchase price attributes to land, PP&E and inventory, and of course, goodwill. So let's look at all four of them. So the higher fair value attributable for land is $20,000. 30% of that is $6,000. Now the value of land that remains unchanged during the year. So there's no impact, there's no write-off. Next, talking about PP&E, property, plant and equipment other than land. The higher fair value attributable to PP&E is $20,000. 30% of that is $6,000. And we said that PP&E, that's going to be depreciated over 10 years. So that means a $600 depreciation or a write-off that we need to account for here. Next, let's talk about inventory. So the higher fair value attributable to inventory was $10,000. 30% of that is $3,000. And the entire inventory with a higher fair value was sold off during the year. So the $3,000 needs to be written off. And finally, let's look at goodwill. So the goodwill was accounted for at $10,000 and it says it's impaired by 25%. So that's $2,500 of write-off. So putting all of this together, we have $600 for PP&E, $3,000 for inventory and $2,500 for goodwill. A total of $6,100 of write-off, which is debited to Circle the income statement or equity in earnings, and it reduces highlight investment by $6,100. Now let's look at the T account for highlight investment. And let's review the journal entries once again as we look at the items on this T account. So the first one is when the investor invests in the investee, that is recorded at cost. So right there, invest and highlight the cost of $100,000. When the investee earns money, that is recorded as earn, highlight $7,500. So that earnings is debited to the investment account. So investment account increases and it also has an impact, an increase on the income statement, equity in earnings. So right there, earn where you have $7,500 under the income statement. Now, when the investee pays out dividends to the investor under the equity method, that's a reduction of the investment account. So on the credit side of the investment T account, highlight $1,800 and write there dividend. finally, when we had highlight $6,100 and write the write-off, that write-off reduces the investment amount, and it's also a reduction of equity in earnings on the income statement. So again, where you have a reduction of $6,100 on the income statement, make a note, right? Write-off. So let's come back to the investment T account. The beginning or the original cost of investment here was $100,000 plus earnings $7,500 less dividends of $1,800 less write-off $6,100. Write the ending and highlight $99,600. So the ending balance of the investment account on the balance sheet is $99,600. Looking at the income statement, equity in earnings. Earnings were $7,500 when the investee made money, and there was a write-off of $6,100. So the net impact on the income statement, equity in earnings, is highlight $1,400. Move to page 7, where we're going to compare, highlight fair value through net income versus the equity method. So we know that the fair value through net income method is used when the investor has highlight no influence over the investee. Generally, we're talking about a less than 20% stake. Equity method is used when the investor has highlight significant influence over the investee, generally a 20 to 50% stake. Under the fair value through net income method, highlight the investment is at fair value on the balance sheet. Whereas under the equity method, highlight the investment follows the equity balance of the investee. Think about it. As the investee earns money, the investment account goes up. As the investee pays out dividends, the investment account goes down. So it's basically following the equity account balance of the investee. Now, talking about earnings of the investee, under the fair value through net income method, it's highlight not recorded. However, under the equity method, as we discussed, highlight record percentage of investee's earnings as equity in earnings on the investor's income statement. Now, when dividends are paid by the investee under the fair value through net income method, it is highlight recorded as dividend income on the income statement. However, under the equity method, the investee dividends do not have any income statement impact. Think about it. As the investee earned money, all of that was already recorded on the investor's income statement. Now, when the investee is paying out dividends, that is highlight a reduction of the investment amount. And the last one regarding write-offs, which is the difference between the purchase price and the book value. Under the fair value through net income method, it does not matter because the investment is at fair value on the balance sheet. However, under the equity method, highlight account for the difference by reducing the equity in earnings on the income statement. Let's say goodwill is tested for impairment. There's a write-off of any land's excess fair value when the land is sold. Depreciate PP&E's excess fair value. Write-off inventory's excess fair value when the inventory is sold. And we looked at all of this on the previous example. Next, highlight comparing journal entries for these two methods. The fair value through net income method, where the investor has no influence,
versus the equity method where the investor has significant influence. So start with, right, invest, the original investment, both under the fair value through net income method as well as under the equity method. It's investment debit and cash credit. For investment, draw an arrow which goes upwards. So investment increases under FVTNI. Same thing under the equity method. The investment account goes up. Next, we have investee earnings. Right there, earn. Under fair value through net income method, there is no journal entry. This is not recorded. However, under the equity method, the journal entry is debit to investment. So draw an arrow which goes upwards as investment account increases. And the credit is to highlight equity in earnings, which goes into, right, I/S income statement. And then we're talking about investing dividend. So right there, dividend. Under the fair value through net income method, cash comes in and the credit is to highlight dividend income, which goes into, right, income statement. Whereas, as we've already discussed a couple of times, because the investee earnings are already recorded on the investor's income statement, as and when the investee earns money, when the investee pays out dividends, that's actually a reduction of the investment amount. So draw an arrow which goes downwards for investment. Next we got, right, write-off. Under the fair value through net income method, it's not accounted for as the investment is at fair value on the balance sheet. However, under the equity method, there is a debit to highlight equity in earnings, which goes into the, right, income statement. And draw a down arrow for investment as the investment account decreases with the write-offs. So we've seen write-offs for goodwill impairment, depreciation of PP&E, for inventory, which is the higher fair value but sold off after the investor acquired the stake in the investee. And the last one, what we have here is increase or decrease in fair value of investment. Draw a bracket and write there, fair value change. And this is relevant for the fair value through net income method because both the increase and the decrease in fair value is recorded. If there's an increase in fair value, investment, right, goes up, and there is highlight a gain on, right, income statement. If there's a decrease in fair value, the investment account, draw down arrow, goes down, and there is highlight a loss which goes into the, right, income statement. Now, we've learned that when the investor has no influence over the investee and the fair value of those investees' equity securities are not readily determinable. For example, the investee is a private company. In that case, the exception rule kicks in, where the investor accounts for those investment in equity securities using cost, which is adjusted for any impairment losses as well as any observable price changes. So basically, the fair value change has no impact unless, underline, it's an impairment or observable price change. Now, under the equity method, again, the fair value changes have no impact. So underline no journal entry unless the fair value option is elected. And we'll talk about this on the next page. On page 8, we look at one final recap of fair value through net income versus the equity method, highlight the income statement and balance sheet impacts. Circle balance sheet. Now on the balance sheet, under the fair value through net income, highlight the investment is at fair value. Whereas under the equity method, highlight the investment is at purchase price plus percentage of earnings minus dividends and minus write-off of excess purchase price over the book value of the investee. And we've seen this in detail on our example. Next, circle income statement. So under the fair value through net income, on the income statement, we have highlight dividend income and highlight gain or loss from a change in the fair value of investment. So if the fair value of the investment increases, that's a gain on the income statement. If the fair value of the investment goes down, that's a loss on the income statement under the fair value through net income method. Whereas under the equity method, we have highlight equity in earnings on the income statement, which includes percentage earnings of the investee minus any write-off from the excess purchase price paid by the investor over the book value of the investee. Scroll down on this page, and on the third major bullet, right, for significant influence, instead of equity method, and highlight may elect fair value option. That's generally if the investee stocks are traded in an active market, where you measure at fair value on the balance sheet and any unrealized gains and losses go into the income statement. Basically, you write account similar to FVTNI. So basically, what we are saying is even if the investor has significant influence, instead of going for the equity method, the investor can elect the fair value option, where he accounts for the investment in those equity securities, where he's got significant influence, similar to the fair value through net income method. Basically, the investment is recorded at fair value on the balance sheet, and any gains or losses due to changes in fair value are recorded through net income on the income statement. This option may be elected on an instrument by instrument basis on certain election dates. For example, date when the investment is first recognized per the equity method, but is underlined irrevocable once selected. On the next bullet, highlight changes in ownership percentage. So how do you account when the investor reduces his holding in the investee, or when the investor increases his holding, such that, let's say, the investor moves from significant influence, the equity method, to no influence, let's say the fair value through net income method, or vice versa, moves in from no influence, fair value through net income method, to significant influence, the equity method. Now, these changes further to FASB's simplification initiative effective December 2016 need to be applied for prospectively. That's now and forward. So the new method is accounted for prospectively. Now let's flip back a few pages and get to page 2. And we have a quick recap on investment in equity securities. So situations with no influence use the fair value through net income unless the cost exception applies. Significant influence use the equity method, may also elect the fair value option But if the investor has control, more than 50% ownership, need to consolidate. So basically, how to account for investment in equity securities, as we have noted, is based on ownership percentage. Now let's talk about investment in debt securities. Now, debt securities could be classified as highlight held for trading or HFT, or highlight available for sale AFS, or highlight held to maturity HTM. So if the investor intends to sell the debt securities in the near term, that's like held for trading. If the investor in debt securities has the intent and the ability of holding those debt securities, those bonds, till maturity, then you use held to maturity. But let's say if it's something in between, so the investor neither has the intent of selling it in the near term nor the intent and ability of holding till maturity, then the debt securities get classified as available for sale. So guys, the investment in debt securities needs to be classified. Draw a bracket and write based on intent to hold. So once again, the investor would classify the debt securities as held for trading if the intent is to sell in the near term. Otherwise, classify as available for sale, where the investor may elect underline fair value option. But if the investor has the intent and the ability of holding those debt securities until maturity, then the investor classifies those debt securities as held to maturity. And even in this case, the investor may elect underline fair value option. Now turn a few pages and get to page 9, where we're looking at investments in debt securities. And as we've already discussed, debt securities may be classified as highlight trading or held for trading securities, highlight available for sale securities, or held to maturity securities. Draw a bracket there and write classification is based on management's intentions. So held for trading securities, as we discussed, are debt securities bought and held with highlight intent of selling them in the near term. And I want you to highlight, think of it as an investment in inventory. You're buying the inventory and you want to sell it off in the near term. Similarly, trading securities, buy, sell. Next is available for sale securities. Highlight, think of it as investment likely to be sold someday. Maybe not in the near term, but someday you're going to be selling those debt securities. But if it is held to maturity, the investor has highlight intent and ability to hold until maturity date. And I want you to highlight, think of it as investment never to be sold in the market. So the investor is going to wait until let's say the bonds mature, and he goes to the issuer of the bonds and collects the amount which is printed on that bond on the maturity date. Now, talking about accounting for all these three different types of debt securities, circle balance sheet. Now, on the balance sheet, held for trading securities, they are carried at highlight fair value. Available for sale securities, again, they're carried at highlight fair value. However, held to maturity debt securities are carried on the balance sheet at highlight amortized cost. Think about it. As the held to maturity securities are not ever going to be sold, the fluctuations in the market price don't matter, they're ignored. Instead, the difference between the cost of buying the securities and the maturity value is amortized over the life of the security. So, if the investor purchased those held to maturity securities at a premium, the premium is amortized over the life of the security. If the investor purchased the held to maturity debt securities at a discount, that discount is amortized over the life of the security. Basically, draw an arrow and write amortize using effective interest rate method. And right, we're going to cover this in FAR 4.2, where we'll have detailed discussion on bonds payable. Now guys, in this section, we are looking at the investor's perspective who's investing in debt securities or investing in these bonds. In FAR 4.2, we will look at the issuer's perspective who's actually issuing the bonds. And that is where we'll cover in detail the effective interest rate method to amortize the bond discount or bond premium. Okay, so we've looked at the balance sheet impact, held for trading, available for sale at fair value, held to maturity securities at amortized cost. Now let's talk about circle income statement. So the interest income for held for trading or available for sale securities are part of non-operating income. For held to maturity securities, we're going to look at interest income net of any discount or premium amortization. Now, if the debt securities are sold, and that's applicable for trading or available for sale securities, the realized gain or loss on the sale of those debt securities again are part of non-operating income on the income statement. However, if there is, put a box around unrealized gain or loss, which means there's a fluctuation in fair value. If the fair value goes up, that's an unrealized gain. Fair value goes down, an unrealized loss. Unrealized because the investor is still holding on to the securities, hasn't sold them yet. So such unrealized gains or losses on these debt securities go in to highlight the income statement, non-operating income, if it is trading securities. But for available for sale securities, these unrealized gains or losses highlight goes to statement of comprehensive income, that's OCI, and this is the A of the PACE, available for sale debt securities. And this unrealized gain or loss highlight accumulates in the balance sheet. So guys, you see an arrow which goes into the balance sheet where we have highlight cumulative unrealized gain or loss is in the balance sheet as accumulated OCI. So the unrealized gain or loss for the period on these available for sale debt securities is part of OCI, other comprehensive income, which gets accumulated in the balance sheet equity section as accumulated OCI. Turn on to page 10, where we've got an elaborate example to compare the accounting for trading securities versus available for sale securities. So let's look at the data points that we have here. So it says the purchase price of the debt security on 1st Jan year 1 is $100. The fair value as of 31st December year 1 is $110. And the investor has not yet sold off the security. So this is, draw arrows and write $10 unrealized gain. Then if you look at the fair value as of 31st December year 2, it goes up further to $115. So right there in year 2 we have $5 again unrealized gain. And then you have the security being sold on 30th September year 3 for $118. That's an extra, right? $3 gain vis-a-vis the price, the fair value that we had on 31st December year 2. And in brackets, right, total there is $18 realized gain on the sale of the security in year 3. Now the question is, how do we account for this if this is held for trading security versus if it is an available for sale debt security? First, let's talk about accounting as if this is a held for trading security. And look at the journal entries that we have there. So on 1st Jan year 1, when the security is purchased, so the investment account is debited and cash goes out. On 31st December year 1, when there's an unrealized gain, the credit is to highlight the gain which goes onto the income statement. Highlight $10 and write there I/S for income statement. Again, on 31st December year 2, there's an additional highlight gain of $5. Again, write the I/S because that gain goes into the income statement. Guys, remember, we said for trading securities, even unrealized gains and losses go into the income statement. And that's exactly what's happening here. In year 3, when the debt security is sold, cash is debited. The investment that goes off from the balance sheet, and there is an additional highlight gain of highlight $3, and this again goes into right income statement I/S. Below the table we got the financial statements for highlight trading securities, where in year 1 we had highlight $10 getting into the net income. In year 2 we had highlight $5. Year 3, $3. So once again, for trading securities, all gains or losses, whether realized or unrealized, go into the income statement. And now let's compare this with the accounting for available for sale debt securities. So let's go up on the table for journal entries. So on 1st Jan year 1, when the available for sale debt security is purchased, debit is to the investment account, credit cash. On 31st December year 1, the $10 unrealized gain on available for sale debt security, that does not go into the income statement. As we discussed, that goes into, put a box around accumulated OCI, and right there, park at balance sheet. So that's not going into net income. That's going into OCI on the comprehensive income statement, which accumulates as accumulated OCI on the balance sheet. Again, the $5 unrealized gain in year 2, that again goes into, put a box around accumulated OCI, and right there, park at balance sheet. So guys, look at the difference between trading and available for sale securities. Trading securities, even unrealized gains or losses get into the income statement. For available for sale securities, unrealized gains and losses do not go into net income, do not go into income statement. They go into OCI on the comprehensive income statement, and from there they are accumulated in accumulated OCI in the equity section of the balance sheet. However, in year 3, when the security is finally sold, then we said it's a $3 gain in year 3, but a total of $18 realized gain. So that $3 gain in year 3 now goes into highlight income statement, highlight the $3 there. How about the $15 of unrealized gains on that available for sale debt security which is now sold, which is parked in the balance sheet? We're going to reclassify it. So we're going to debit accumulated OCI, and the credit would be highlight to gain of $15 which goes into the income statement. So draw a bracket around the $3 and the $15 and write I/S. So once again, in case of held for trading securities, we saw that $10 of gain went into the income statement in year 1, $5 in the income statement in year 2, and $3 in the income statement in year 3. However, in case of available for sale debt security, we saw that the gains did not go into the income statement at all in year 1 and year 2. They were parked as accumulated OCI. Only in year 3, when the security was sold, when there was realized gain or loss, did it have an income statement impact. And the entire $18 was gain in year 3. So scroll down on this page and let's look at the financial statements for highlight available for sale securities. So if you look at the income statement, $0 of net income in year 1, 0 in year 2, and highlight the entire $18 in year 3. The $10 of gain in year 1 went into OCI. The $5 of gain in year 2, again OCI, accumulated OCI. In year 3, that $15 was reversed, or draw an arrow from that negative 15 to the plus 15 and right there, reclassify when the gain is realized. So if you look at the balance sheet, on the asset side, as we discussed, the investment is going to be there at fair value. So at the end of year 1, the investment is at $110. Year 2, $115. Of course, in year 3, the investment is sold off. Now, when you look into the liabilities and equity section, on the equity section, you would see retained earnings does not have any impact in year 1 and year 2 because nothing went into the income statement. In year 3, we have the entire $18 which went into net income on the income statement and retained earnings on the balance sheet. And put a box around accumulated OCI and its numbers. So if you see accumulated OCI in year 1 has $10. In year 2, it increases to 15. So guys, 10 in year 1 plus 5 in year 2. The accumulated OCI number becomes 15. In year 3, all of that $15 gets reclassified into the income statement, into net income, because the gain in year 3 becomes realized. So basically, accumulated OCI is more like a parking lot where you park unrealized gains and losses on available for sale debt securities. And draw an arrow there, right? Cumulative unrealized gains. So guys, one last recap here. Both trading securities and available for sale securities are to be recorded at fair value on the balance sheet. Now, the changes in fair value would result in gains, losses. Until the security is sold, it's unrealized gains and losses. The moment it's sold, the gains and losses become realized. Now, for trading securities, both realized as well as unrealized gains and losses go into the income statement, into net income. something like what we had under the fair value through net income method for equity securities. However, for available for sale debt securities, things are a little different. The unrealized gains and losses do not get into the income statement. They are parked in accumulated OCI on the balance sheet until the gains or losses are realized, which is when you reclassify to income statement. So guys, unrealized gains and losses from available for sale securities into OCI, accumulated OCI. The moment it's realized, that's when it goes into income statement. Turn to page 11, where we have highlight the valuation allowance account. So basically, this is a contra asset to record temporary fair value changes for held for trading or available for sale securities. That means any change in fair value is adjusted on this allowance account. And we saw this allowance account on the examples on the previous page. So right there, temporary increase or decline goes into valuation allowance. However, if there's a decline in fair value, that's not temporary, that's like permanent. That's what we call an impairment loss. So right there, other than temporary decline equals impairment. Let's read this. If debt securities suffer a loss that is other than temporary, then the value of the security must be written down to fair value, which becomes the new cost basis, and the amount of write down is treated as a realized loss. So guys, basically, if there's an impairment loss on securities which the investor continues to hold, technically, though it's an unrealized loss, it's accounted for as if it's a realized loss. So if you look at the loss on impairment on the journal entry, that goes into the income statement. Make a note there, right? Treat unrealized loss as realized loss. That means on income statement, even if available for sale / held to maturity. On the next bullet, we're looking at highlight reclassifications. So the classification of debt securities is based on management's intentions. And intentions, guys, they can change. So reclassifications may happen as a result of highlight changes in management intentions. So at each balance sheet date, the entity, the investor, needs to reassess if the classification of the debt security is appropriate. Let's look at the table that we have here. And our focus is going to be on, put a box around the unrealized holding gains or losses when there is a reclassification. So the first couple of rows talk about transfers from or to the trading or held for trading category. The first one is when there's a reclassification from trading to available for sale or held to maturity. In this case, for the unrealized holding gains or losses, highlight there is no adjustment as any unrealized gains or losses are already recognized in the income statement. However, if the transfer is from available for sale or held to maturity to trading, in that case, any unrealized holding gains or losses on that debt security is highlight recognized in the income statement. The next couple of rows talk about transfers between available for sale and held to maturity categories. So if the transfer is from HTM to AFS, think about it. Basically, we're moving from amortized cost to fair value, and any unrealized gains or losses in that process is recorded in OCI on the comprehensive income statement, goes to accumulated OCI on the balance sheet. And the last one, if the transfer is from available for sale AFS to held to maturity HTM, think about it. We're already going to have some unrealized gains or losses as part of accumulated OCI. And you need to highlight amortize already existing balance of unrealized gains or losses in accumulated OCI over the remaining life of the debt security. And the next bullet talks about fair value option. So this fair value option can be elected for available for sale or held to maturity, where all realized as well as unrealized gains or losses on income statement, even if AFS or HTM. So basically what we're saying is, for an available for sale security or a held to maturity security, if the fair value option is elected, technically you need to account for them as you do for trading securities. So highlight may elect fair value option for AFS or HTM, where measure the securities at the fair value on the balance sheet and include any unrealized gains or losses in the income statement. So guys, for an available for sale security, you could use the available for sale security method or elect fair value option. For HTM, held to maturity, you could use the held to maturity method, record at amortized cost on balance sheet, or elect the fair value option. So the fair value option may be elected on an instrument by instrument basis on certain election dates. Basically the date when the investment is first recognized by the entity, but is underlined irrevocable once elected. I want you guys now to take a step back. I want you to flip back all the way to page 2, where we have the executive summary for investments in equity as well as debt securities. So if you look at the investment in equity securities, the accounting was based on ownership percentage, whether there's no influence, there's significant influence, or there's control. For debt securities, the accounting was based on the intent to hold, where the security could be trading or available for sale or held to maturity. Now, under investment in equity securities, when the investor has no influence, we use the fair value through net income method, where the security is at fair value on the balance sheet and any gains or loss resulting from changes in fair value are recognized through net income on the income statement. Now, this is pretty similar to the held for trading accounting for debt securities. And if you realize, we actually have a fair value option for all the other methods of accounting. So under investment in equity securities, when you have significant influence, could use equity method, may even elect the fair value option. Also, when you're looking at investment in debt securities, let's talk about available for sale. Though the security would be recorded at fair value on the balance sheet, any unrealized gains or losses are recorded in accumulated OCI. But you could elect the fair value option, where unrealized gains and losses go into the income statement. Again, for held to maturity debt securities, which are an amortized cost on the balance sheet, the investor may elect the fair value option, where the security now gets recorded at fair value on the balance sheet and any unrealized gains or losses resulting from changes in fair value goes into the income statement. Now I want you to turn on a few pages and get to page 15, which is a blank page. And let's use that page to recap all that we've learned about, right, debt securities and highlight that. So as we know, the three classifications of debt securities, right? HFT, that's held for trading, right? AFS, and right, HTM. Now let's talk about, right, balance sheet valuation for these debt securities. Held for trading, on the balance sheet, they are on, right, fair value. Available for sale, again, they are on, right, fair value on the balance sheet. Held to maturity, these are on, right, amortized cost on the balance sheet. Next, let's talk about the income statement impact. Starting with, right, realized gain or loss. And realized gains or losses from sale of debt securities, that is always recorded on the income statement. So, right, I/S for all the three classifications. And then let's talk about, right, unrealized gain or loss. Now for trading securities, unrealized gains or losses, they also go into, right, income statement. But for available for sale securities, we know that unrealized gains or losses are the A of PACE, who go into, right, balance sheet, circle that, and write accumulated OCI. So the unrealized gains and losses from available for sale debt securities are parked as accumulated OCI on the balance sheet until those gains or losses are realized. And when they are realized, we know that we reclassify them to net income on the income statement and to retained earnings on the balance sheet. Now for held to maturity securities, there's actually no unrealized gains or losses. So write the NA and draw an arrow upwards because these securities are recorded at amortized cost on the balance sheet, not at fair value. Now let's talk about, right, exception number 1 for AFS and HTM, and that is impairment loss. So write 2 column headings for AFS and HTM. Let's talk about balance sheet valuation. For AFS, we know it's, right, fair value. But for held to maturity debt securities, which are otherwise recorded at amortized cost on the balance sheet, if there is an impairment loss, we need to bring them down to the new, right, fair value and highlight it. Next, right, unrealized loss only, because we're talking about impairment loss. And unrealized losses due to impairment, as we know, are treated as if it's a realized loss. And both for available for sale and held to maturity securities, the impairment losses, though unrealized, are recorded on, right, I/S income statement and highlight under both these classifications. Now let's look at, right, exception number 2 for AFS and HTM, and that is, right, fair value option is elected, and highlight that. Let's put in the 2 column headings for AFS and HTM and write balance sheet valuation. For AFS, that's always right fair value. But for HTM, which was otherwise recorded at amortized cost on the balance sheet, the moment the fair value option is elected, these are now recorded at right fair value on the balance sheet, and highlight that. Talking about right unrealized gains or losses. Now, if the fair value option is elected, that means that the securities need to be at fair value on the balance sheet, and any gains or losses, whether realized or unrealized, need to be recorded through net income, recorded on the income statement. So write I/S for AFS and I/S for HTM and highlight these. So guys, one final recap before we move on. So when you look at trading debt securities, they are recorded at fair value on the balance sheet, and any gains or losses, realized or unrealized, is recorded on the income statement. Now, available for sale debt securities and held to maturity debt securities are accounted for similar to those trading securities if any of the exceptions apply. The first exception that we saw was an impairment loss, where we have unrealized losses. And the second exception was when the fair value option is elected by the investor for accounting for these available for sale or held to maturity debt securities, where, as I said, they are accounted for at fair value on the balance sheet, and any unrealized gains or losses go into the income statement. Turn back to page 12. We'll be looking at financial instruments, which include financial assets as well as financial liabilities. Examples of financial assets are highlight cash, highlight securities, and we've already spent a lot of time talking about investments in equity securities, stocks, as well as investments in debt securities like bonds. Financial assets could also be highlight derivatives, basically right to receive something, favorable derivatives. Financial liabilities may include bonds payable, so that's like the issuer of the bond, and we're going to talk about this in FAR 4. Financial liabilities could be highlight derivatives that impose an obligation to pay, sort of unfavorable terms. Scroll down on this page where we're talking about highlight required fair value disclosures for financial instruments measured at amortized cost. So we're talking about the held to maturity debt securities, which are at amortized cost, where you need to disclose fair value even if not carried at fair value. Though this disclosure is optional for non-public entities, it is required for highlight public entities. The next sub-bullet, highlight required disclosure for concentration of, on the next line, highlight credit risk and put a box around concentration. So credit risk is the risk that the other party may not perform as per the contract terms. Basically, it is the risk of default. And entities are required to disclose all significant concentrations of credit risk arising from all financial instruments, including derivatives. So concentration could be due to activity, region, or economic characteristics. The next sub-bullet, highlight optional disclosure for, on the next line, highlight market risk. So guys, credit risk was the risk of default by the other party. Market risk is the risk of unfavorable changes in fair value of the financial instrument, which could result in losses. So concentrations of credit risk, that's a required disclosure. Market risk for financial instruments, that disclosure is optional. Move to page 13, where we are looking at accounting for financial assets under IFRS. Now, IFRS requires a single model for the classification and measurement of financial assets with two tests, where highlight test number 1 is the business model test, whether the objective of the entity is only to hold the financial asset to highlight collect contractual cash flows, or is it to both highlight collect contractual cash flows, circle and highlight sell the financial asset, and that's prior to maturity to realize any fair value changes. And highlight test number 2 is cash flow characteristics test, whether the contractual cash flows represent highlight SPPI, that's solely payments of principal and interest. And on this page, we have a chart which reflects the IFRS model for financial assets. First, we got highlight test 1, where the question is whether the objective is to hold the financial asset to highlight collect contractual cash flows. If yes, highlight test 2, do the contractual cash flows represent highlight SPPI, solely payments of principal and interest. Now, if both these tests are yes, that means we're talking about held to maturity debt securities. Look at this. If the objective is to hold the financial asset to collect contractual cash flows, and these contractual cash flows represent solely payments of principal and interest, that's one's right HTM. And these held to maturity securities are reported at amortized cost on the balance sheet. Let's again look at highlight test 1, where the objective is both to highlight collect contractual cash flows, circle and highlight sell the financial asset. And if the contractual cash flows are SPPI, basically we are talking about right AFS, or available for sale securities. So once again, for available for sale securities, the objective is both to collect the contractual cash flows as well as to sell the financial asset, and that's why they're available for sale, not held to maturity. Now, in case of test 1, if both the objectives are not met, circle no. Also, test 2 is circle no. Then as far as debt securities are concerned, we are talking about right HFT, or held for trading debt securities, which are accounted for as fair value through profit and loss. Also, right, AFS/HTM if fair value option elected. So for available for sale debt security or held to maturity debt security, if the fair value option is elected, again it is fair value through profit or loss. And to better understand the US GAAP and IFRS terminology for investments in debt securities as well as investments in equity securities, let's get on to the next page. On page 14, let's first look at the second sub-bullet. Circle debt securities. Now, under US GAAP for debt securities, we had highlight HFT, that's held for trading, highlight AFS, available for sale, and highlight HTM, which is held to maturity. Under IFRS, for held for trading securities, we call them highlight fair value through profit or loss, where the security is at fair value on the balance sheet and any gains or losses, whether realized or unrealized, is recorded on the profit and loss account, basically the income statement. AFS, or available for sale debt securities under US GAAP, they are highlight fair value through OCI under IFRS. Again, very similar accounting. So for available for sale securities under US GAAP, we said that they're going to be at fair value on the balance sheet, but any unrealized gains or losses will be recorded in OCI or accumulated OCI on the balance sheet. And that's why they're calling it fair value through OCI under IFRS. Again, held to maturity debt securities under US GAAP. We said they're going to be reported at amortized cost on the balance sheet. And that's why under IFRS, we call it highlight securities at amortized cost. So guys, debt securities, the rules are very similar, US GAAP and IFRS. But of course, terminology is slightly different. Now let's move up and put a box around equity securities. Under equity securities, IFRS allows the below options. The first one, highlight FVTPL. That's fair value through profit or loss. And it's same as fair value through net income that we looked at under US GAAP. Now, under IFRS, for equity securities, there is an extra additional option, which is highlight fair value through OCI or FVT OCI, which is underlined allowed as an irrevocable option. Now, under the fair value through OCI option, any unrealized gains or losses on the equity securities, instead of going into the income statement, they're going to be parked in OCI, accumulated OCI. Pretty much similar to what we saw for available for sale debt securities under GAAP. Note that this is underlined no longer allowed for equity securities per US GAAP. But of course, US GAAP allows this for debt securities under the available for sale category. So guys, that was about investments in equity as well as debt securities. And we've learned both US GAAP as well as IFRS. On page 16, FAR 3.2, we're looking at derivatives and hedge accounting. Now, derivatives are financial instruments or other contracts that derive their value from underlyings like stocks, bonds, commodities, currencies, interest rates, and market indices. Now, derivatives, these have a multiplier effect, and our mnemonic here is sun to the power of n. The first one, derivatives are highlight settled net. That means it's a net settlement in underline cash or cash equivalents. And on the bubble, write S to the power of n. So settled net. Second bullet, highlight underlying and notional amount. So on the bubble there, write U to the power of n, where the U is underlying and n is the notional amount. So the value of the derivative is the product of the underlying and the notional amount. Right there, settlement price equals underlying dollars multiplied by notional number of units. So underline underlying and right there strike dollars. Underline notional amount and write the number of units. And the third characteristic is highlight no or negligible initial net investment. and write n to the power of n on the bubble. So guys, derivatives are settled net. Derivatives have underlying and notional amount, and they have no or negligible initial net investment requirement. And that is where we say derivatives, that's sun to the power of n, or s to the power of n, u to the power of n, and n to the power of n.
On the second half of page 16, highlight types of derivative instruments. Highlight option contract and write there right plus obligation, and cross out obligation because it's a right but not an obligation. Next line, underline call option and write hope equals price would increase. Next line, underline put option and write hope equals price would go down. Highlight futures and forward contracts and write right plus obligation. Underline futures, underline long position and write expect equals price would go up. Underline short position, write expect equals price would go down. Underline forward. So futures have standardized terms and traded on an exchange. Forward, they are customized as per the need of the parties. Highlight swaps and write right plus obligation. Underline interest rate swap. Underline foreign currency swap. And write expect equals what you will receive is more than what you will pay. So guys, these are all your types of derivative instruments. So we looked at options, we looked at futures and forwards, and we've also seen swaps. On page 17, we're looking at accounting for derivatives and hedges. Highlight measured at fair value. Right, hedge equals use derivative to offset risk of anticipated losses. Now, we've got a lovely table here where we're comparing speculation versus hedging. So, speculation is when you attempt to profit from market changes. Gains or losses for speculation, they go to the income statement. Speculation, that sounds like, right, betting. Next column, we have got fair value hedge. This is hedging against the risk of loss from an existing or already recognized asset or liability or a firm purchase commitment. Gains or losses, they go to highlight income from continuing operations on income statement. Now this is because the receivable or the payable or the commitment, all these highlight exist now. And make a note below this column, already have inventory. Next column, we're looking at cash flow hedge. This is hedging against the risk of loss from a planned or forecasted future transaction but not yet a legal commitment. Gains or losses, they go to highlight OCI pays in the balance sheet. Highlight nothing in income statement until the transaction actually occurs. And write plan to buy inventory. On the second half of this page, we're looking at examples of derivatives. The first one, that's on speculation. Look at the journal entry there. So because it was a gain from speculation, the debit was to the receivable on derivative, the credit was to gain on derivative, which goes to right there I/S or income statement. Turn on to page 18 and here we have examples on fair value hedge as well as cash flow hedge. Few lines on that example highlight underlying and highlight notional amount. So we know that underlying multiplied by the notional amount, that's the settlement price. Now let's look at the journal entries. For the fair value hedge, the first journal entry was the loss on market decline in inventory. So on the left, write inventory loss, underline loss and write I/S because this loss goes to your income statement. The gain, that's on the derivative, the fair value hedge. So write derivative fair value hedge. And on the credit, underline gain, write I/S. So we have seen that the 4 million loss on inventory, that went to the income statement. The 4 million gain on the derivative, the fair value hedge, even that has gone to the income statement. So circle the 4 loss and the 4 gain, draw arrows out from them and write wash because of hedge. Highlight both the loss on inventory and the gain on the fair value hedge are included in the computation of net income, so there is no net income effect. And this of course was the goal of the hedge. Next, we're looking at the cash flow hedge. Now, going to the journal entry there, write derivative cash flow hedge. And the debit here is to the loss on the cash flow hedge. Underline loss, write B/S because this loss goes to accumulated OCI on the balance sheet. Circle the 4 million and write loss on derivative will be offset by future planned transaction. Hence, it's parked in accumulated OCI on the balance sheet now. Let's read. It says, note that the loss is not included in the calculation of net income. The reason is that the highlight decline in gasoline is expected to reduce the cost of inventory in the next period. So this loss will be offset by reduction of cost of sales in the next period only. The last bullet on this page, you got a summary for fair value hedges and cash flow hedges. The second sub-bullet, highlight cash flow hedges and write accumulated OCI equals pace. Circle the E, draw an arrow from E and write effective portion of cash flow hedges. So we now know that the E of pace in accumulated OCI, that's the effective portion of cash flow hedges, the unrealized gains or losses on such hedges.
On page 19, we have the disclosure requirements for derivatives. So the first sub-bullet talks about the information which enables financial statement users to understand key information about those derivatives. The second sub-bullet talks about disclosures of the objectives for holding or issuing derivatives and strategies for achieving those objectives. Few lines below, we have disclosure regarding inherent risks of derivatives. Put a box around required because there is a required disclosure for highlight concentration of credit risk. So credit risk, that's the risk of default. And if that credit risk, the risk of default is concentrated, make sure you disclose it. So look at this. In the example on the fair value hedge, Aerofuel faces the risk that the other party may refuse to pay the $4 million net settlement. So that's the risk of default, credit risk. There is put a box around optional disclosure for highlight market risk. Market risk is a risk that the entity incurs a loss on the derivative, and that's an optional disclosure. On page 20, we are talking about hybrid instruments which comprise a host instrument and an embedded derivative. And your job as CPAs is going to be to bifurcate the hybrid instrument. So bifurcate the host and the embedded derivative. Let's look at a couple of examples of embedded derivatives. The first one is an embedded derivative that can be separated from its host. For example, highlight a detachable stock warrant that was acquired with an investment in bonds. So the bonds, that's the host instrument. The detachable stock warrant, that's the embedded derivative. And we're going to cover these stock warrants in FAR 4. Now, you could also have embedded derivative that cannot be separated from its host. For example, highlight convertible bonds. As we have noted on top of this page, the hybrid instrument should be bifurcated. That means the host and the embedded derivative should be separated if all of the given conditions are met. And the first condition is that the embedded derivative meets the characteristics of a derivative. And you can write the SUN, sun to the power of n, and highlight S. So the embedded derivative meets the sun to the power of n criteria. The second one is the hybrid instrument is not regularly recorded at fair value, and highlight H. And the third one is that the economic characteristics and risks of the embedded instrument is not clearly and closely related to the economic characteristics of the host contract. It means they look very, very different. Highlight E. So, guys, another mnemonic here. We're talking about SHE or she. So, she, the embedded derivative, needs to be bifurcated or separated from him. That's the host instrument.